So chapter 1, an introduction to published accounts. What we're going to look at here, guys, is we're starting off with an understanding of the theoretical concepts which are absolutely essential to me. So everything within this chapter and the second and third chapter is your understanding of theoretical concepts. So what we're looking at is the theory. Learn the theory and you'll understand almost every single accounting standard. So learn the theory and understand almost every single accounting standard. That's potentially how important these first few chapters are. From my teaching perspective, I always spend the first half a day going through theory, always. Because if you get this, the rest of it just fits in. And as we go through the rest of the syllabus, I'll keep on bouncing back and saying, remember that thing we were talking about within that earlier theoretical chapter? This is it now being applied. This is what it's all about. Okay? Now, you will be doing a lot of writing as I go through this, so it's unlikely that you're going to be able to get all this down to the PowerPoint slides that we've printed off, so you may need some extra paper to cross-reference in here. To start with, I'm going to talk to you about some of the terminology. Now, the terminology that we're looking at will include international terminology. I will talk to you about the UK-based terminology, but this is an international accounting standards-based exam, so it's international standards I'm going to talk to you about. Okay? What we have is IASs, which are International Accounting Standards. And if I'm teaching my granny to suck eggs, I apologise for that, but not everybody knows what all these things stand for. So International Accounting Standards, these are the older standards. So IASs are the older standards. IASs are being slowly updated and replaced by IFRSs, which is International Financial Reporting Standards. So they're being gradually replaced by IFRSs. That said, some of the IASs, the International Accounting Standards, are still absolutely essential to everything that we do, up to and including IAS 1, which looks at presentation of financial statements. So that gives us our first step into the theory, the very, very first IAS. Okay? As you go through your studies and as you go through work, you'll notice that there are more IFRSs out there than the ones that we talk about. We only have to go up to IFRS 16, so we don't need to go beyond anything along those lines. IAS has only got up to 41. You don't need to know all of them. Okay? What will happen here in the real world is you will use these standards on a day-to-day basis. If you are using the international standards, brilliant, that will help you with your studies. If you're using the UK variant of those standards, which is generally FRS 102, what that now means is there may be some slight differences. As we go through these standards, I'll try and highlight what the differences are so you can see how you're using it is not the way I want it examined. Okay? Because it all depends on where your client's from. What we then have are various different other concepts and different terms you need to learn parrot fashion. Everything on this slide is potentially a Section A multi-choice question. So now what we have is materiality. Materiality is all about the way that our users' decisions are affected. So it's all about the way that our users' decisions are affected. An item becomes material because it will influence my users' decisions. So an item becomes material because it will influence my users' decisions. An item becomes material because it's either a high value item, which means it has a big influence on the overall reporting that we're making, or because of the nature of the item. So it's either value or nature. Any transaction with directors is automatically material because that will influence my users. Okay? You may find that low value transactions can be material if you've got a situation whereby you've only made a small profit or a small loss, because that may now change the profile of that profit or loss into a loss or a profit. So it's not just big numbers, it's any small numbers where you have just a small profit or a small loss. So it depends upon the size of the business, depends upon the actual results, it depends upon the nature of the transaction as well. What we're trying to do here is we're trying to produce financial information which allows our users to make financial and economic decisions. So we're trying to allow our users to make economic decisions. That now means that our users need to understand what's happened and what's potentially happened somewhere else. So what we're looking at there is comparability. Comparability is the ability for my users to understand what we've done and then compare it with what somebody else has done. The somebody else is potentially within our industrial sector, is potentially overseas. And as long as they're using the same standards, we should be able to compare accounts for any company within the world, theoretically. Okay, doesn't always quite work. Comparability also works on a temporal basis. Basically, that means it's Doctor Who. So you're looking at time travel. So comparability looks at our results this year compared with our results last year. You can then build up a trend of how well or how badly we've performed over the last number of years. That now means we can influence our understanding of performance, which means that directors are going to get a bonus or they're all going to get sacked. Aggregation is just a fancy way of saying adding things up. As a general rule, we don't like the idea of adding things together if we think that disclosing these items separately would be useful to our users. Big focus on my users. So we don't like aggregation where our users would like to see things disclosed separately. We need to disclose them separately. However, that said, if you have a class of, say, assets such as cash at bank, I would like to see just a single figure for cash at bank because that shows me my overall net liquidity at that specific point in time. That means I don't want to see 5 or 6 different lines saying cash at bank number 1, number 2, number 3, number 4. You're now detracted because you're focusing my attention on nothing but those bank accounts. Means I'm going to not look at everything else. So in that type of situation, aggregation can be useful. But again, it all comes back to our users and how those users are going to use this financial information. So it all comes back to our users and how these guys are going to use this financial information. Okay. Make a love note here, guys. Cross-reference this through to IAS 2, which looks at inventories. We'll look at inventories on day 3. Because what we do with inventories is we will aggregate everything within inventories, but the way that we value them is not always the same, because you're looking at lower of cost and NRV for every line of inventories, which means you could be adding up the cost for one and then the NRV for another to add up, could give you an overall net figure, which means nothing to anybody. Okay, so aggregation doesn't always help our users. Fair presentation is all about true and fair views. So this is about me trying to give a true and fair view. The directors of the company have a duty to make sure the financial statements produce a true and fair view. So the directors have a duty. The directors must make sure that these statements are correct. Okay? The auditors do not have a duty to make sure these financial statements are true and fair. The auditors will form an opinion on the truth and fairness of those financial statements. They haven't been doing the work all year, therefore they can't guarantee that everything is 100% correct. But what they will do is they will add additional comfort to me as a user that what the directors have produced is reasonable. So they give me additional comfort as a user that what the directors have produced is reasonable. Remember, the core reason behind producing financial statements is stewardship accounting. We've got management and control line with our directors, we've got ownership line with our shareholders. Therefore, we force the directors to tell me as a shareholder what they have done with my money. The directors are stewards of the shareholders' assets. So that stewardship accounting is essential to understand what we're trying to achieve here. In the same way that we're not keen on aggregation, we're not keen on offsetting. Offsetting is where you have two different numbers, which one will be a positive, one will be a negative, and then you just offset them against it. So you just offset them against each other and come up with a net figure. That is not usually okay. So that is not usually okay. However, there are certain standards which allow for offsetting. So there are certain standards that will allow for offsetting. And as we come across these standards and we start talking about offsetting issues, think about the impact on the numbers on the financial statements now. Think about the impact on the way that we will interpret performance and the financial position of the company because of the way we are offsetting these numbers against each other. Is this giving my users a true and fair view? If it is, then happy days. If it's not, then we've got a problem with that standard. Okay, so you actually get to critique an awful lot of the standards to say, yes, this is a good one because it gives my users exactly what they want, or no, this is a bad one because users don't understand this. Okay. We've also got this idea of exceptional items. Exceptional items will be looked at in a lot more detail later on, but exceptional items are unusual things which will require additional disclosure. So exceptional items are unusual things that will require additional disclosure. If these things require additional disclosure, by definition, they will be material. So they will be material. Because if they're not material, I'm not going to bother. The materiality concept says if something isn't material, don't bother telling me. Even if it's an exceptional item, if it's not material, I don't care. Don't bother putting it anywhere. Okay? So from that perspective, there's only certain things that can potentially be material. Therefore, there's only certain things that can be exceptional. Okay? But we'll look at exceptional items in more detail on days 3 and 4. The first standard you need to have an awareness of is number 1. So the first standard we're going to look at is going to be IAS 1. IAS 1 is absolutely essential. It's the cornerstone of everything that we're going to do here with regard to financial reporting. IAS 1 looks at the presentation of financial statements. And what IAS 1 is, IAS 1 will give us an idea of the type of information that needs to be disclosed. So it gives us an understanding of the type of information that needs to be disclosed. It also tells us how we should disclose it. So it tells us what should be disclosed and it tells us how to disclose it. IAS 1 is designed to make sure that our financial statements are comparable with previous results over time. So IAS 1 should ensure consistency of how we report on an ongoing basis. So that comparability comes about because of consistency of how we report every year. IAS 1 should also ensure comparability due to consistency with the way that everybody else reports during that current year. So the comparability comes about because of consistency. If you have that type of consistency, it allows for comparability. That comparability now allows us to have a much better understanding of our performance over a period in time and our financial position at a point in time. So it gives us a better understanding of our financial performance over a period in time and also our financial position at a point in time. Okay. IAS 1 tells us the minimum amount of information, so it tells us the minimum amount of information which must be disclosed. That means it includes things such as profit and loss account. It includes things such as statement of financial position. It includes things such as notes to disclose additional information. So it tells us what type of key primary statements we must be producing. So it tells you what key primary statements we must be producing. Okay. Now the key primary statements that we're going to produce will include, and I'm going to go through these in a little bit of detail. We've got our statement of profit and loss. The statement of profit and loss shows the total, and the word I'm using now is very specific, shows me the total realized gains and losses during the period. So the statement of profit and loss shows the realized gains and losses. That means it's a profit or loss which has come about because I've actually effected a sale. So it's things such as me selling something. The OCI, which is an extension of my profit and loss, so the OCI, which is an extension of my profit and loss, Stands for other comprehensive income. This other comprehensive income, so other comprehensive income will include, and again the word I'm using now is very specific, if the P&L is realised, OCI looks at recognised gains. So the OCI looks at recognised gains. That can include things such as revaluation of a non-current asset. So the revaluation of a non-current asset will go through the OCI, and that can now become part of my performance evaluation of the directors for that year. Because the directors may have actively made a decision to hold on to that asset because they think it's going to increase in value. The profit and loss account does not show that performance as being particularly good. The OCI will now allow me to see that that was a really good decision. So the OCI and the P&L together allow me to have a better understanding of performance across the entire year. Okay, so those two statements go quite closely hand in hand. And if you're looking through your notes, guys, what we've done is we've got an extract on page 6 showing a profit and loss account. So you've got your profit and loss account, which is a bog standard profit and loss account, nothing spectacularly important in there. But then down at the bottom underneath that, you've got the OCI, the other comprehensive income, so page 6. And what that does is it shows you how you can actually see these two different statements coming together, and when I produce those two things together, it now gives me a good understanding of performance of the business across the entire year. Okay, does that make sense? Every time we look at some sort of gains or losses, which are not necessarily coming about from a sale, so it's not something I've realised, consider, should I be putting it in the P&L, should I be putting it into the OCI? From a user's perspective, we now need to train our users to make sure that they understand that a better performance evaluation statement is not just the P&L by itself, but P&L plus OCI. So you need to include that from a performance evaluation perspective. Okay? Fantastic. That OCI is quite useful to me. And you will potentially within this constructive response question in section C have to produce an OCI. Okay? So that stuff on page 6 is potentially there. Go.
So would some unrealised gains?
Sorry?
So unrealised gains.
Yes. So unrealised gains, but they're recognised gains. Yeah. So you can actually see that there's going to be some very keen funkiness with regard to financial instruments in there, where the financial assets and financial liabilities are valued. That can have an impact on the P&L account or on the OCI, depending upon what type of instrument we've got, and then depending upon our intention, whether we want to hold it to maturity or not. We'll come to that in more detail when we get to the financial instruments bit, which is a bit of a bind. It's quite a nasty standard, but the good thing is you've only got to learn a certain part of it. Okay, so the way that we examine it at that FR level is quite low level. Then what we have is our statement of financial position. If you flick back a page, what you've got on page 4 is a standard statement of financial position. This is basically a snapshot of all of the assets and all the liabilities at a specific point in time. So this is all of the assets and all the liabilities at a specific point in time. Okay, and what happens here is, and this is very specific, guys, and I appreciate that you may not have seen this format before. Some of you will have, depending on which papers you did before. I tend to put the assets at the top, and I'm just going to list out my assets, and then I'll put my equity interest, which is my ownership interest, next, and then I'll put my liabilities. What this does is it says debits at the top, credits at the bottom. So debits at the top, credits at the bottom. The general rule, and it's not an exact rule anymore, the general rule is as I work my way through the assets, as I get to the bottom of the list of my assets, they become more and more liquid. So when I'm looking at current assets, I look at inventories, then receivables, then cash in hand. Because cash is more liquid than receivables, receivables is more liquid than inventories. Okay. Also, current assets are more liquid than non-current assets. So you tend to find that non-current assets will come first. It doesn't always work in exactly that way within non-current assets, because what tends to happen within non-current assets is we look at tangible assets first, then intangible assets. Okay, so we'll tend to look at tangible assets first, then intangible assets. My understanding of this is intangible assets are usually not particularly liquid. So the ordering there goes a little bit against the theoretical grain. So just have an awareness of that. I'll give you marks for getting the format right if you get this type of constructive response question. Okay. However, within tangible non-current assets, you will list them down based on the number of years you'd expect to use them for. Remember, the definition of non-current asset will include economic benefits over a period in excess of 12 months. So it's got to be numbers of years. So buildings tend to go at the top, then things like fixtures and fittings, etc., plant and machinery, all based on the number of years of life that they've got left. Okay, I appreciate these are estimates, but it gives my users an understanding of what's going on. And you'll notice here at the top of page 4, you've got things such as PPE, then investments underneath, and then intangible assets. Intangible assets are nowhere near as liquid as the other two because it's really hard to sell an intangible, but it's possible to sell it. It's just very, very difficult. Okay, then what we have is our SOCIE, the Statement of Changes in Equity. Now, as an accountant, I love the SOCIE because the SOCIE does everything I would like to see my profit and loss account and my OCI doing. The profit and loss and the OCI doesn't always do it. What the SOCIE does is it reconciles last year's balance sheet or last year's statement of financial position to this year's balance sheet or this year's statement of financial position. So it just reconciles last year's statement of financial position to this year's statement of financial position. And you've got an example at the top of page 5 there, guys, to make sure you're happy with it. And what this does is it says, here's last year's figures, here's all the different movements that can have an impact on it, and then at the very bottom, here's my carried forward figures. This is my current figures. That means that any type of profits that are generated from the profit and loss account, so my net profits will be shown in this SOCIE. So net profits are shown in the SOCIE because they will add on to my retained reserves, which is part of my equity interest. So profits for the year get added into the SOCIE because they get added into retained reserves as part of my equity interest. In addition to that, any type of unrealised but recognised gains within the OCI will be dumped in here as well. So any type of revaluation movements get shown within my SOCIE as well. Okay, so revaluation movements get shown within my SOCIE as well. The SOCIE is supposed to show me all transactions with my user group. So it's supposed to be all transactions with my ownership interest. That means if I issue fresh shares, that goes through the SOCIE. So the share cap might go up, share premium might go up, share cap, share premium will have their own columns. It's a nice simple format. And when you get this type of question in the exam with that sort of supposed maybe sort of spreadsheet there, it's actually designed to allow you to do this. Okay, so share cap, share premium, that can be processed through there without any bother whatsoever. This is the interesting bit. Other transactions with your ownership interest will include dividends. The dividends that we are going to pay during the year do not have to be shown on the face of the profit and loss account. If you had a profit and loss account which showed the dividends and your users go straight to the bottom figure, that now encourages me not to pay dividends out. Users want to see dividends. So if I've got a profit of $100 and I've just paid out $70 worth of dividends, that now means my retained figure is $30. My users would look at that $30 and go, $30, that's not a good return this year, is it? Okay, because they don't understand how the dividends fit in. So we show the dividends here instead. Okay, so the profit and loss account does not have to show the dividends. You can if you want, but it doesn't have to show the dividends, but we will be showing it within your SOCIE anyway. So that now means that all transactions with your ownership interest get dumped in here. That makes it really useful. And as an accountant, we love this because it reconciles last year's statement of financial position to this year's. Okay, fantastic. Then what we have is our statement of cash flows. And what you've got to remember here, guys, is we're trying to produce primary financial statements that are going to provide useful information to my ownership interest. So we're trying to provide useful information to my ownership interest. I'm also trying to provide useful information to other user groups as well. Other user groups here can include things such as providers of debt finance, so banks and other intermediaries. If you've got a bank here, they're not interested in profits, they're interested in cash flows. And we've got some real life examples of why this is so important. You all heard of Carillion. Carillion were making profits year after year, and they were doing lots and lots of really, really great things according to their financial statements. They just didn't have any cash. Okay, so Carillion supposedly had great performance because their financial statement said everything was brilliant. The company still fell over, and it fell over because it was really badly managed from a cash perspective. Okay, does that make sense? There was actually a report on BBC last night. I don't know if anybody saw the BBC News last night. It's on the BBC website as well, about some bloke who used to be a manager at Woolies in Manchester, and how the fallout from Lehman Brothers, which fell over 10 years ago yesterday, how that now means that some guy in Manchester's Woolworths branch loses his job. And it shows how the liquidity within the markets dried up, which meant that our companies potentially don't have any cash. This cash flow statement is absolutely essential. Okay, absolutely essential. And if you do decide to go on to do the advanced performance management paper, and I would suggest you do it because it's a really easy paper, we look at things such as EBITDA. EBITDA, earnings before interest and tax, depreciation and adjustments. It's an approximation to cash flows. It's the best way of valuing a business, basing it on cash flows rather than trying to base it on profit flows. Okay, so this type of thing pulls forward into quite a lot of the P-level papers as well. The notes that we have, and this is the really interesting thing, notes are a primary financial statement. This is the type of multi-choice question you get in section A. Notes are included as a primary financial statement. The notes are absolutely essential because the notes will allow me to expand on one number and give my users a much deeper understanding of everything which is going on. So these notes will give me a much deeper understanding of what's going on. You can have a single number split down to various different component parts. You could have things such as receivables split down into an aged analysis, so you can work out the risk associated with your receivables. If I'm a user, risk is really important to me. I like that idea. Okay. You could have a look at things such as a segmental analysis, which we're expected to do now as well, to show me how much turnover is coming from different types of regions, how much turnover is coming from different types of products. That now allows me to see the risk associated with the regions and with the products. If there's a change in the economy, I can now factor that into my expectations of what's going to happen with this company in the future. The way that we produce these notes to give our users extra information aids the predictive value of financial statements. And that's a really important aspect as well. I would like to look at my financial statement to be able to predict what I think is going to happen next year. The financial statements are designed to allow that. Now, the type of decisions we're looking at is users' decisions, basically shareholders' interest is as decisions, and we're looking at should we have a buy, sell or hold decision with regard to my shares. So should I buy some more? Should I sell some? Should I just hold on to them and see what happens? The financial statements plus your understanding of the external economic environment will now allow you to work out what next year's results should be. And that's why when PLCs start releasing results, we have an expectation level, an upper and a lower expectation of what those results should be. Because we know what's happened in the past, we then predict what's going to happen in the future, change it based on the economic outcomes that we've seen during the year and say, there's our expectations. That's why share prices don't move significantly when companies produce results. It's already factored into the share price. Okay, and I'm not going to start harping on about EMH, so don't worry. Are we happy with that so far? Fantastic. Now, there are other aspects that we need to have an awareness of. The accruals concept, which is also known as the matching concept. What I would like you to do here, please, boys and girls, is you need to match income and expenditure to periods. Do not match them to each other. If you match them to the right period, you will automatically match them to the right income and expenditure amounts. So match them to periods, and then you'll find it an awful lot easier. We've also got this idea of going concern. Going concern is an absolutely critical concept. And what we're going to do is we're going to bounce back into this page 4 statement of financial position. Going concern says that the business will continue for the foreseeable future. The foreseeable future is at least the next 12 months. It's the same definition as the auditing foreseeable future. So we expect the business to continue in operation for at least the next 12 months. If the business is going to continue for more than 12 months, that now means that we can have non-current assets, non-current liabilities. Going concern allows us to have non-current assets, non-current liabilities. If your business is not a going concern, you cannot have non-current anything. Everything becomes current automatically. Okay, so everything becomes current automatically. Now think about the impact this could have. You could potentially have bought some plant and machinery. It's cost you maybe $100,000. You're going to depreciate it over 10 years, 10% straight line basis, nice and simple. 3 years in, you've got a £70,000 or so $70,000 net book value. Just 3 years with depreciation knocked off it. Now what happens is your business is going to cease for the next 12 months. That non-current asset now becomes a current asset. You can't value it at NBV anymore, so net book value is not appropriate anymore. You must value it at the lower of cost, which is the 100,000, or realisable value, which is probably about 20,000. You've now just taken an extra 50,000 hit immediately to this year's profit and loss account. That's why when firms say that they're going to cease trading, their profits go and just shrink. Okay? Because the valuation principles for current assets are different to the principles for non-current assets. Does that make sense? You need to have an awareness of that. I've seen that come up as a Section A question as well. Which of the following would not be appropriate if this was not a going concern? Non-current anything. Everything becomes current. Okay, so everything must become current there. Fair presentation. We've talked about the idea of fair presentation, the idea of true and fair presentation, the idea of trying to present stuff in such a way that our users understand it. If you adhere to IFRSs, so International Financial Reporting Standards, you are prima facie, so on the face of it, you are automatically giving true and fair presentation. So if you adhere to IFRSs, you're automatically adhering to fair presentation. Okay, consistency, we've talked about. Consistency will allow for comparability. So consistency will allow for comparability, and that comparability will now allow my users to make economic decisions. So comparability allows for economic decisions. We've talked about materiality and aggregation. That aggregation, the other side of that is then the offsetting side of things. We've talked about offsetting, and we've talked about comparability as well. Are we happy with all that so far? Fantastic. Okay. One of the issues we've got is all of these various different standards, the IFRSs, are designed to be used around the world. So IFRSs are designed to be used around the world, which is why they have an element of flexibility. So all of the IFRSs have an element of flexibility. Some have more flexibility than others. Some of them give you optional ways of accounting for things. That's because these IFRSs must be appropriate for every single culture in the world. Just about every major economic player in the world uses IFRSs in one way, shape or form. The only economic power which doesn't use them is the US. Okay, and there are some reasons for that, and I'll talk you through some of the reasons when we come to IAS2 inventories. We talk about FIFO, LIFO stuff. The Americans like to do things in a certain way. IFRSs do them in a different way to that. They didn't like it. So there was a big convergence project about 7 or 8 years ago where we brought lots of these standards together in the US and internationally. There was just some gaps we couldn't cross. Okay, so what now happens is we give you an element of flexibility. This is where the subjective nature of IFRSs kick in. This subjective nature of how we apply our IFRSs will now lead to a detraction in consistency and a detraction in comparability. So the flexibility is good because we can use it everywhere, but it's bad because it leads to a lack of comparability. You, as the accountant, have to work out, you have to make a subjective decision, so you have to work out which is the best way to account for something and which is the best way to disclose it. Okay? Now, some of the flexibility which we've already got built into IAS 1 includes things such as the various different names of the statements. So I've been talking about a statement of financial position, and every now and again I float in and call it a balance sheet. Balance sheet is the UK name for a statement of financial position. That's the FRS 102 name for a statement of financial position. If you want to use balance sheet in the exam, I'm probably not going to be very keen on it because this is an international exam, but your clients will understand balance sheet. If your users understand it, then use it. So if your users understand, then just use it. Okay? From an exceptional items perspective, if you've got an item that you think is really unusual and it's material, you can potentially disclose it on the face of the primary financial statements, on the face of the statement of financial position, or the face of the profit and loss account, or you can show it in the notes. That now means that two companies can be performing exactly the same activities. One decides to disclose that figure on the profit and loss account, says this is an unusual amount, either a gain or a loss. The other one doesn't, just shows it in the notes. Which one's going to have a better performance? Which one is viewed more favourably by our users? If this is a positive figure, then the one that doesn't show it as an exceptional item looks like it's doing better. If it's a negative figure, then the one that shows it as an exceptional item looks like it's doing better, because exceptional items are not recurring. Okay? So you can actually force users to have a specific viewpoint based on how you disclose or don't disclose exceptional items. Okay? That means that type of subjectivity means that you're influencing your users' decisions. This is where the ethics kicks in. You've got to disclose the information in such a way that you do not influence your users' decisions. Okay? The way that we disclose dividends, I've talked to you about the way that we can disclose them within the SOCIE. You can potentially put them into the SOCIE, you can potentially put them into the P&L account if you want to. It's very, very, very unusual to see them on the face of the P&L account, because that now makes it look like I haven't got a really good performance. So I'm probably not going to put them in the P&L account. So you can put them in SOCIE, or you can just dump them into the notes. Okay? So that now means that I can hide these things in the notes, because not everybody looks at the notes. That's the problem. Will all of this cause problems? Yes, it does cause problems. It leads to a lack of comparability and a lack of consistency. Is it good though? Yes, because it means that extra level of flexibility allows for every culture in the world to actually be able to use these standards. And that's our key objective here. So we want to make sure that everybody can use these standards regardless of where you're from. Okay, are we happy with that, guys? Right, back into the notes, looking at page number 4, looking at our statement of financial position. I'm going to keep on shortening this down to SOFP or SFP, because especially when I start typing these things up, my typing is not the greatest. So what we have is a template for my statement of financial position. You need to learn the template. So that's it, you just need to learn that template. The difference between current assets and non-current assets comes about because of the period over which we will generate economic benefits. So it's the period over which we will generate economic benefits. If it's less than 12 months, it becomes current. If it's more than 12 months, it becomes non-current. Make a love note here, please, guys. Cross-reference this through to non-current assets when we are holding them for sale. So you have assets held for sale. They shouldn't be shown as non-current because we're going to sell them soon. But certain criteria have to be met before we're allowed to do that. Non-current assets will be held for the longer term, and you will then consume those economic benefits over that longer term. Therefore, we need to show the consumption of those economic benefits over the longer term. That now allows me to have a depreciation charge. So depreciation is a measure of the consumption of economic benefits of a non-current asset. And bear in mind here, guys, if you have a situation whereby, the business is now not a going concern, you are not allowed to have non-current assets. Okay? Working our way down, within the ownership interest, within our equity portion, we just tend to list out everything. So share cap, share premium, retained reserves, any miscellaneous other equity-based reserves. So if you think about statement of changes in equity, that SOCIE figure looks at things such as movements in revaluation reserves. So our revaluation reserve will be dumped in here as well. So you've got share cap, share premium, retained earnings, which is an accumulation of all of our profits since inception. The other reserves there will include revaluation reserve. Because if the business was wound up now, that revaluation reserve would have to be paid out to the ownership interest. Then when we start looking at liabilities, I look at long-term liabilities first, then shorter-term liabilities. So non-current liabilities, then current liabilities. The equity is shown first because that's a super long-term liability. That's only ever repaid when the business is wound up. So that's only ever repaid when the business is wound up. Okay, so super long-term liabilities is equity, then long-term liabilities, which would be normal long-term loans, and then current liabilities, which will be short-term issues, which may potentially now include things such as payables. Make a love note here, guys, cross-references through to leases when we look at leases, because leases can have short-term components and